And we're
Yay,
live.
we're live. Hooray.
Hello, hello. Happy Thursday.
Happy Thursday, everyone.
Welcome to Stake Your Wealth, the live edition. If you watched this week's video, it was on the power of index funds and investing in humanity.
I love that. That was a great title.
Yeah. I got it actually from the two of my favorite financial bloggers. Well, my number one top favorite one is Mr. Money Mustache. And he turned me on to this idea of financial independence years ago. I mean, probably, I'm trying to think when I first ran into him, like maybe 2015. Yeah. And he just totally changed my perspective on what it means to be financially independent and how to get there.
Yeah.
And so for me, that was very motivational. But he has a friend of his, J.L. Collins. And J.L. Collins has a lot of these but quite in-depth write-ups on personal investing, not fancy, sophisticated stock manipulation, just really basic bread and butter personal investing. And it's amazing how simple it is once you actually understand what goes into it.
Right.
But one of the key...
That goes into investing.
That goes into investing.
Oh, okay, right.
The only kind of investing we ever need to do, right? Not the kind of investing where you're trying to make a living off of it. This is just investing where you want to put your money to work, right? You don't want it just sitting in a bank getting eroded by interest. You want to put it in some kind of asset class that's going to continue to appreciate.
Yeah. Unless you need to access that money.
Well, that's the beauty of it. Even though, for example, if you put it into an index fund, a brokerage account, you can still pull it out, right? You can sell it instantly. There's not like it's not locked up.
Okay.
If you put it in something like real estate,
then
that's more illiquid.
Yes.
Right.
Okay.
So you have liquid assets and illiquid assets. Liquid assets being the most easy to use and access.
Transfer into money.
Right. Cash. Cash is the most liquid.
Yeah.
Right? You can literally use it instantly to pay for something.
Right.
Then you get to things like stocks, which you can sell, but there is that transaction time, and some brokerages require a couple of days until the money reaches your account to spend.
And it might not be the right time to take it out.
Yeah, well, there's market timing. That's a whole separate. Actually, next week we're going to be talking all about market timing, so we'll get into that.
Okay.
And then you have things like real estate, which are illiquid, meaning
you can't take your money.
You can't just go and sell it. I mean, you could just go and sell your house, but even then, it takes a couple of weeks, and you got to process stuff, and there's a lot of transaction fees, a lot of friction involved with turning it into cash.
Yeah.
So in any event. What J.L. Collins was talking about was the power of index funds.
What's his name?
J.L. Collins.
Yes.
Yeah, I think his name is Jim, but there's another. It's confusing because there's another financial
with the same name.
It was a personal finance guy called Jim Collins, I believe.
Oh,
and he's like a big name.
Not related.
Not related. Oh. No. So this guy goes by J.L. Collins. And he's just like a very salt of the earth kind of guy who is really smart about,
How did he learn about this? From experience, trial and error? Or did he?
I think he read a lot, honestly.
Okay.
Yeah. He had, he talks about this in his book. He had a period of his life where he was, a little bit sort of
like lost,
directionless. Yeah. And he always just wanted to sort of do things his way. And to really do things your own way, you need financial independence.
Yeah.
But what a lot of people don't realize is that financial independence is much more accessible than they think. They think when you think of financial independence, you think
like 60 years old,
millions of dollars, right?
Yeah.
More money than you can spend. But that's not really what financial independence means. So anyways, going back to this idea of
where you put your money.
Yeah. A lot of people think, okay, fine, I don't want it in cash. Let's put it into stocks. But that's where they stop. And they're like, okay, so now I'm trying to invest in the stock market.
Yeah.
What do I do?
Right.
Right? Like if you wanted to put your money into the stock market right now,
Yeah.
And you just searched online,
Yeah.
do you have any idea what might pop up? Are there any apps that you've heard of?
Well, I know the ones from you.
Right.
But before you've been sharing your knowledge about this with me, no, I would have no idea.
Right. So if you looked, you've heard of Robinhood.
Yeah,
right?
And I know that there's some scandal associated with them right now.
Well, it's not so much a scandal, but yeah, Robinhood is the epitome of the mistakes people are making with investing.
Okay, so
right?
Why is that?
Because Robinhood is all about individual stocks.
Oh, right. Okay.
Right?
Yeah.
Robinhood is all about, everyone on the planet pretending they're a day trader, trading stocks for a living.
Okay.
And it's tempting, right? That's why I try to get across in the video. It's like when you see stocks jump, like if you invested in Amazon.
Yeah. They're like, okay, of course.
10 years ago.
10 years ago. Yeah.
It was just like the appreciation is enormous.
Yeah.
Right.
But right now, if someone were to do that, I think they'd feel pretty confident taking on that individual risk. Right.
Yeah. I mean.
But it's not the best way to go about things. Right.
Right. And
from your video that I learned about. Yeah.
Right. But the issue is that individual stocks carry a lot of risk.
Yes. Okay, let's talk about individual risk, what that means, like define it.
Yes.
Okay, so
and risk is essential.
It's essential.
Essential.
Okay.
To understanding the concept.
Okay.
But it's also essential to making money, right?
Risk and reward, that sort of dichotomy.
The whole world of investments has to do with the balance of risk versus reward.
Yeah.
Right?
And you want more reward for minimal risk.
Yeah. And in fact, this deserves a video of its own, just the conversation of risk versus reward.
Yeah, definitely.
The more risk you take, the bigger your reward can be.
Right.
Right? The less risk you take, the less reward.
Yeah.
But again, it's less risk. There's less to worry about.
And it's scary to stretch yourself too thin, right? In any type of whatever you're dealing with. It could be seashells, it could be money, it could be time. Just stretching oneself too thin can be a little, you're teetering on a brink, right, of something. So
exactly.
It could be very disconcerting for someone.
Unsettling, yeah. Absolutely. When you look at, like, a classic example in recent memory is the Bitcoin bubble, right? And I'm a big crypto proponent, but not so much as an investment class. I love the idea of the technology itself.
Decentralized.
Right.
Yeah.
But there was a period of time where Bitcoin went from $200 to $20,000.
I know, I remember that. It was what, 2017?
Yeah, something like that. But that's a 1,000% increase. And you don't get 1,000%, or it might even be 10,000%. I think it's a 10,000.
People were buying houses based on like just using their Bitcoin investment.
Right. It was just nuts. And people, when you hear that, you're like, I want
I gotta get in on it.
Yeah. How amazing would that be to turn all this money into that?
But what I love the point that you made in the video that you put out earlier this week, it resonated with me what you said, in that by the time you hear it, it's been through so many different communication channels, so many other people who have, easier access to that information will have already known that, and it's already been like time has passed by the time you get that information. So what you now know is this, like, eureka moment of how to invest something. It's already, time has flown.
It's old news.
It's old news.
Yeah.
So
that's the crazy.
Scary.
That's the crazy part about this. News in the financial markets moves really, really quickly.
Yeah.
And so by the time you hear about Bitcoin, unless you're, a crypto expert, by the time you hear about it, chances are it's already super appreciated. So what happened is, yes, it went from $200 to $20,000, right?
Yeah.
But most people got on at like the $15,000 mark. And so they bought it at $15,000. It went up to $20,000. They're like, I'm going to ride this to $100,000, right?
And maybe it didn't go.
No, it didn't.
It went.
It hit 20 and then
it
plummeted down.
Right.
And it went down to like 6,000. It stayed at around 6,000 for a while.
Right.
It's at like 10 now, 11.
It's pretty steady.
Pretty steady now. Yeah, it's stabilized. But a lot of people who invested at 15 and now it's down to 10, well, they just lost, 30% of their investment, 33%.
Nuts.
which is really painful as an individual
Of
investor.
course,
There were
yeah.
people who literally put their entire
Ugh,
life savings into
no,
this stuff.
No.
And it's the same concept with individual stocks,
Right.
right? You're putting all your eggs
In one basket.
in one basket. Yeah.
You want to diversify.
Boom. That's it, right? That's the number one key to risk, managing risk.
Yeah.
If you want to reduce your risk, you got to spread it out.
Right.
Of course, by reducing your risk, you're also going to reduce the chance of appreciation.
Yeah.
Or the scale of appreciation, right? So
Yeah, that makes sense. But at least they'll all appreciate a little bit. Like, it's just a more steady and safe way of doing things.
right.
And there's less risk of it plummeting, somehow.
Right. As long as the diverse basket
Yeah.
is uncorrelated.
Right.
So let's stick with crypto for a second.
Okay.
There are a bunch of other cryptocurrencies out there, right? So you have Bitcoin, but you also have Ethereum. You have Ripple.
There's like 100 different ones at least.
Thousands.
Oh my gosh. Wow.
Yeah. They have big indexes of them.
It's crazy.
Right? Zcash. Gosh, there's too many. Cardano, Monero.
Just Google different types of
Yeah.
Bitcoin, and you'll see so many.
Coin market cap.
Yeah, well, like
Boom.
wonky
Get
names
one big list.
for things.
Everything. Oh yeah, they come with hilarious names. But
It's
let's
kind
go
of
with that.
like currency in a video game.
Oh, it's totally a video game.
Like, do you remember that
And
game?
that was the point
Neopets. There was some weird
Yes.
currency with that.
Yeah.
Right?
Neo dollars.
Something like that.
I
right?
remember. Yeah. Doubloons. They had doubloons.
Fun game.
So in any event,
Yeah. Crypto.
crypto, right? You invest in Bitcoin. You're like, I'm smart. I'm going to diversify.
Right.
Right. I'm going to go.
To like Ethereum. And
I'm going to add Ethereum, and I'm going to add, Ripple.
Yeah.
Right.
But it's still not diversified enough because it's still Bitcoin. It's still crypto.
Yeah. Exactly.
Yeah.
Right. That's
Yeah.
exactly right. So the problem with that is, yes, you're diversifying, but you're still diversifying within a fairly homogenous,
Yeah.
right? A fairly similar group of assets.
Yeah.
So the problem with that is when one goes up,
The other one goes.
the other goes up. When one goes down, the other goes down. So it's, even though you've technically diversified across cryptocurrency,
not enough.
they're all moving in
The
unison.
same trends.
Yeah.
Yeah.
And they shouldn't be, by the way, right? Different cryptocurrencies have different, properties and advantages and benefits. So technically, they should be moving independent of one another. But because it's just all speculation right now,
Right.
most investors in cryptocurrency have a basket of all of them. They have
Oh,
their,
so they're all going together.
so they're all moving together,
Right.
right?
In a flock.
Right, exactly.
Right.
They basically have the top 20, maybe even top 100 cryptocurrencies, and they all go up and buy some
Together.
or sell some more, and they all go down.
Groupthink.
Groupthink.
Yeah.
Yeah. A lot of that in the investment world too.
Yeah.
So okay, so
So individual risk.
individual risk. The way to mitigate it
Yeah.
is to diversify, like you
Yep.
said.
Mm-hmm.
But the key when you diversify is that your assets that you're diversifying with need to be uncorrelated. And when they're uncorrelated, when one goes up,
The other one might do something else.
exactly,
It goes up, it might not.
exactly. That's exactly it, right? You don't know what the other one's going to do, and that's the good thing.
Yeah.
Because
You're not reliant on that same
Right.
trend.
because with one goes up, that means let's say you have two asset classes, right? One goes up and one stays flat, right? Compared to just having all your investments in the one that goes up, you're going to make a little less profit,
Right.
right?
But in the long term, it's less risk. And over time, it's more reward.
Well, I wouldn't say it's more reward, but it is
No?
like you're right about the less,
Less
risk.
risk,
You're
yeah.
definitely right about that.
I mean, I feel like.
Because let's talk about the reverse scenario.
Okay, yeah.
So we were saying when it goes up,
Yeah.
if you have them in two different asset classes, this is one going way up and this is the one sort of staying flat,
Yeah.
right? If you had it in one, they both go up,
Yeah.
right? Everything goes up and you make the most money. If you have it spread across two, one goes up, one stays flat. So your profits are sort of averaged, right? Between those two.
Yeah.
So it's not as much.
Okay.
So you're like, shoot, well, maybe I should have just stayed the one, then I could
No.
ride that train.
No.
But then what happens when they go down?
Yeah, exactly. You just
Right?
never know.
When they
feel
go
like-
down, if you have all your investments in one asset class, you lose way more because all of it gets lost.
Right.
It's that hedge with that separate, it's not even a hedge really, but it's that spreading your risk into an uncorrelated class
Just use another basket.
that helps dampen the fall. So
Yeah.
you could think of it in general as just like it's like a muzzle or a silencer on like an exhaust pipe, right? It just makes everything a little softer. And so the highs aren't as high, but the lows aren't as low either, right? It just sort of it equalizes the volume. The frequency, right? A lot of one very common sort of what's the word heuristic that you get in finance is a frequency chart, right? The ups and downs, the fluctuations.
Right, the Dow Jones, you'll see that.
They all have a frequency. And
NASDAQ.
if you think of frequency as this wave going up and down, by diversifying your risk, the highs are lower and the lows are higher, right?
So it's more medium, flatter.
Yeah.
Which is safer.
It's safer. And guess what?
Safe wins.
Safe wins, but safe is also boring, right? And that's the problem. People don't want safe.
Oh, I see. They want that like adrenaline rush.
Why do people go to Vegas?
Silly.
You're not going to Vegas to make, what, $10 off $100. You go to Vegas to make, $1,000 off $100.
So it's a behavioral change that has to take.
Yeah, it's very
place.
behavioral.
Yeah.
It's very behavioral.
Like if you ask me, I would definitely do the steady, like safe.
And you'd be a smart investor.
Yeah.
Right?
Yeah.
But most people don't want that. They're looking at the stock market as almost like a lottery ticket.
I just don't get it.
They're like, they're looking at it as an opportunity to
make big money fast,
to escape whatever their current financial situation is.
There's also an issue, but it's not their fault necessarily. It's this idea that our society like gives us these false messages about earn money fast, cash fast. Like you see it all the time. These like gimmicks, these even like on YouTube, I see like people's thumbnails be like cash fast, make quick money. It's like, no, there's not really any such thing.
100%.
So it's not like, don't get fooled by this notion of, you take a hunormous.
Yeah, I love that. Let's use enormous.
Talk about spoonerism. That's one right there for you. A huge, enormous risk.
I'm using enormous. That's the coolest word I've heard.
Okay. But yeah, I think, society tends, at least American society, but you see it all over the world too. It's like cash fast money, quick passive income streams.
Yes.
Like,
it's
just like.
And that's what we brought up Robinhood earlier. That's, one of the issues that I've been talking about with Robinhood is Robinhood's whole pitch is you might be lucky, you might get lucky, but they don't even present it as lucky. They present it as you are smart enough to beat the market, right? You can do it. You know better. You just needed to be enabled. You just needed this app to help you make your...
You needed Robinhood.
You needed quick and easy access to the stock market to put your genius, plan into motion. And for most of us, I hate to break it to you, we aren't geniuses, right?
Yeah.
Most of us, in fact, even the professionals, I talked about this in the video, the professionals, 95%.
Yeah, what was it, like 5% of the time? But they're working with billions of dollars. They have so much capital.
The way that metric works, by the way, is it's not that 95% of them lose money.
Yeah.
It's that they don't beat the market. They don't beat the market.
Right.
So when we think of the baseline sort of earnings,
what do you mean exactly by beat the market?
Exactly. So the market, when we say the market, we're talking about the stock market.
Okay, right.
And that's just the general overall stock market. And the easiest, there are a few different indices that you look at to sort of determine what is the market.
Yeah.
But the sort of the core ones are like the Dow Jones Industrial Average, the NASDAQ, and the S&P 500.
Yes.
So most of the time when you read any kind of financial literature and they say the market's up, what they're really saying is
those three
aggregate are up. Okay. But you also have the Asian markets.
Yeah, exactly.
And you have the European markets, right? And all of those can technically be combined for one overall average. Yeah. But most of the time, honestly, if you want to really simplify it, the S&P 500. Okay. S&P 500 is just the top 500 companies. Yeah. And it just tracks the market cap.
They're, ebbs and flows.
Exactly. Yeah. And so when you talk about, these investment vehicles and these hedge funds and
The people who put your money places.
Yeah, your financial managers. What they're trying to do is do better than the market.
Beat the market.
Beat the market.
Yeah, do better than
Right.
those trends.
To do
or
better than those trends.
predict that certain stocks will
Beat the market through that.
Through that, okay.
Through predicting that certain stocks, certain assets, it's not always just stocks,
perform
right? Yeah, it
better.
can be real estate, it can be other things,
Right.
Commodities. But their goal is to sort of outperform the general market.
What do they base that on? Like a new product coming out?
Oh yeah, they all
like-
have their proprietary
Okay,
strategies,
algorithms.
Yeah, and they want to convince you that they have the best ones. They want to convince you that theirs is better than everyone else's.
It sounds like smoke and mirrors to me.
It is, and so they charge a management fee. So the typical market return after inflation for the stock market is about 7%.
Okay.
Right.
Right.
So most of the time when we say beat the market, you're doing better than 7%.
Right. Right.
So these guys are going to claim they can do 9% or 12%.
Yeah.
Right? Well, they better claim they can do 12 because they're going to charge a 2 to 3% interest.
Oh my gosh! Right.
On all their
they have a fee.
Earnings. They have a fee. Yeah. Not even on the earnings, rather on how much you invest. So if they're charging 3% and you're making 7% in the market, and they're charging 3%, you need to at least make 10% to beat the market, right? Because you have to cover their costs too. It's really hard to get a 10% return on the stock market. You can do it. It's just hard to do without taking a lot of risk.
Yeah.
So my approach, and it's not just my approach, the approach of smart personal investors is to stop trying to chase above market returns.
Right.
What your goal should be is to capture market returns. Market returns mean you invest in something that just follows the market.
Right.
Because overall, the market still goes up. 7% is 7%.
Yeah,
that's higher than inflation's average, like 2 or 3%.
It's better than 0%, right?
Yeah.
So things like Betterment and Wealthfront, they diversify portfolios, right? Because they're helping you invest in different stocks as opposed to just one.
Exactly.
Thing.
So we talked about in the video index funds. So index funds, what they do is they take a bunch of different stocks, uncorrelated, and put them together into one big.
Right. And you don't really choose what's.
You don't choose. The different financial firms actually build these index funds for you. And they can
AI.
be ETFs, they can be mutual funds.
It's AI, right?
No, actually,
Are there actual people managing this?
There's individuals who I'm sure they're AI-based ones too. But the point of an index fund is that it's based on some kind of concept, right?
Right.
And so there are actually, I should correct what I said, which is not all index funds are uncorrelated, right?
Okay.
So sometimes an index fund might track a specific market.
Okay.
Right, you might have a very specific one that follows precious metals.
Yeah.
Right, those are all correlated.
Right.
But this way, you're not only investing in gold; you're also investing in silver and lithium and a variety.
Yeah, precious metals.
But that would be an example of an index fund.
Yeah.
But then you get broad market tracking index funds, and broad market tracking index funds cover a much broader array of indices, and that way they're a little less correlated.
Right.
So those are index funds.
Yeah, and they reduce risk.
Right. They're not as exciting.
Right.
They're kind of,
Slow and steady wins the race. Remember the rabbit and the hare? That's the same thing. What was it? The tortoise and the hare.
Yeah. Exactly.
Yes, tortoise and the hare.
The tortoise wins.
Nobody wants to be a tortoise, but
and plus the tortoise has an awesome shell.
Tortoises are pretty cool.
Yeah. Although my what is it? I'm the year of the rabbit, so maybe I should support the rabbit. But I'm totally a tortoise. I like.
But there is no turtle, right, in the Chinese zodiac.
I know.
So
if there was,
then you'd be. You're such a turtle.
If there were. So what Betterment and Wealthfront do is they take a variety of index funds,
and they disperse it,
and they combine them into one.
Into one
big platform.
But you're still getting that diversified.
So if you invest $1,000 in Wealthfront, what they'll do is they'll put 30% of it in American small, medium, large cap funds, right? There's basically small, medium, large business type funds. They'll also put a little bit in real estate fund. they'll put a little bit in
Like
government
technology?
bonds,
Okay.
right?
Okay.
And municipal bonds,
Right.
the bonds that are issued by cities. Then they'll also give you some European exposure,
Yeah.
right, to the European markets.
And then Asian.
And then Asian markets and emerging markets.
Great.
Right? So it's spread across. And so when one goes up, the other goes down. You know, in a recession, they all go down.
Right.
Right?
But that's like what you were saying about betting on humanity. Like,
and that's where betting on humanity
it's
comes
like
in.
if it's to the point where it's like apocalyptic, like we have bigger fish to fry.
Exactly.
You know?
Yeah. And so when you get into those situations, it's like, okay, yeah, well, no one's benefiting apart from some very specific groups. So, but then it recovers.
Yeah.
And when it recovers, they all recover.
Right.
And you recover with them.
Right, exactly.
And that's because humanity overall, like think about it, we live better than we did 100 years ago.
Yeah.
Better than we did 1,000 years ago.
And our ancestors went through so much, right? The fact that we're here is testament to our ancestors' ability to survive.
Yeah.
Wars, famines, like,
exactly.
You know, natural disasters.
Every
all these kinds of
generation has
things.
made the world, the future, just a little bit better. It doesn't
yeah.
always feel that way.
It doesn't feel that way, but each generation thinks that their generation is the last generation.
Yeah.
So you're not alone in feeling those feelings,
Right.
but it's still better than before.
It is, objectively.
Yeah.
If you look at sort of quality of life
Yeah.
On an aggregate, if you look
Yeah.
at access to
Clean
amenities,
water.
necessities,
Yeah.
luxuries,
Yep.
we live like kings compared
Yeah.
to someone 100 years ago. So in any event, the point is humanity continues this sort of relentless upward march.
Yeah, which is
and by
good.
investing in the market,
You're investing in.
you invest in that. And
humanity.
that's how you can reduce your risk in the stock market,
Right.
right? Is by just tracking the market. Stop trying to beat it.
Yeah, don't
Just track
beat
it.
the market. Just
Make your money elsewhere
yeah.
and use this as just a slow, gradual, steady wealth
Yeah,
generation engine.
yeah,
Yeah.
for an extra cushion.
Yeah.
Yeah, so
Whew,
fascinating.
yeah, there's just so much
There's
to
a lot
talk
to
about.
talk
And I
about.
feel like we jumped around a bit here, but I think the core theme is pretty clear,
Yeah,
right?
so do you want to do a quick summary?
Yeah, I mean, the core theme is essentially don't try and beat the market.
Right.
Just try and match the market.
Yeah.
And there are services out there that make it really easy to match the market now. I talked about Wealthfront and Betterment.
Yeah.
Those are the two
Vanguard,
best ones in my
right, is
opinion.
good.
So Wealthfront and Betterment both include Vanguard.
Okay.
So Vanguard would be an example of a company that creates an index fund.
Okay. Okay.
Yeah.
Got
But
it.
you can, some people
Yeah.
literally just invest
Just-
in Vanguard
right,
products because
right.
they're great. They're low fee.
Yeah.
And they have a variety that do a good job of sort of tracking large indices.
Yeah.
But yeah, so the idea is don't try and get flashy, right?
Yeah.
Don't take on so much risk with an isolated or highly correlated investment. Because yes, the ups are big, but so are the downs.
Yeah.
And as individual investors, those downs can be really painful.
Yeah, especially if you put all your eggs in one basket, and like that's never a good thing, right?
Yeah.
So lots of great information.
Yeah, we'll keep these coming.
Yeah, and then for Wealthfront and Betterment, you have a link, right? You're gonna put that maybe
Yep,
below.
I'll throw those in the show notes if that's a way to support us. If
Yeah.
you feel like you want to get into the stock market in a low risk, intelligent, and managed way at a very low cost, both Wealthfront and Betterment are awesome. We're not sponsored by them, but they do provide these referral links. So if you sign up, you get a benefit. You get a referral bonus. I get a referral bonus. Everyone wins. So yeah, definitely check that out.
Yeah.
And of course, if you have any questions about this conversation, if you have any ideas about future conversations that you'd love to hear about, just let us know.
Yeah. Leave a comment.
Yep. And we'll catch you next week and keep your eye out for the next video.
That's right. Happy wealth staking.